So today we're going to take some time to talk about candlesticks, and we're going to take a look at 4 basic candlestick patterns. This particular book, The Candlestick Course by Steve Neeson, is a very, very good, highly recommended book. And I'm going to tell you, I'm going to read from a little bit here so you guys can kind of get a little bit of background about how candlesticks started, because really in Western trading and economics, candlesticks were not something that a lot of people were doing until, a few decades ago even. So let's just get a little bit of background information. So I'm going to start on page 15. It's the Essentials, section 1. And it says, the financial markets represent some of the most exciting and challenging arenas on earth. Those who participate in these markets conduct research by utilizing 2 basic types of analysis, fundamental and technical. Fundamental analysts pore over fiscal statements and company reports, and technical analysts scan charts to assess a market, stock, or any other financial instrument. Though the fundamentals are important, the shorter the time frame, the more important the psychological component of the market becomes. And the only way to measure the emotional aspect of the markets is through technical analysis. Indeed, there are many times when the emotional conditions of the market overwhelm the fundamentals. For example, how many times have we seen the appearance of a positive fundamental news, something comes out in favor, the futures are approved, only to have that market descend? Brexit. It went the other way on everyone. Even if we have a strong stock based on the fundamentals, what's likely to happen to that stock or crypto if the overall market is down sharply? Replace overall market with Bitcoin or the big 3. Of course, the negative psychology of the overall market will influence that crypto or stock, even if the fundamentals didn't change. Now I'm going to scroll ahead a little bit because I want to talk about where candlesticks come from. Okay, so the use of candlestick charts originated in Japan. Since little or no currency standard existed during those times, rice represented a medium of exchange. Feudal lords would deposit it in warehouses in Osaka and sell or trade the coupon receipts whenever they chose. Therefore, rice became the first futures market. In the 1700s, Munahisha Hama, a rice trader from a wealthy family, studied all aspects of rice trading from fundamentals such as weather to market psychology. He subsequently dominated the rice markets and amassed a huge fortune. Hama's trading techniques and principles eventually evolved into the candlestick methodology used by Japanese technical analysts with the start of the Japanese stock market in the 1870s. So this is old stuff, but it didn't quite make its way to the West for a while. Now it says the greatest advantage to using candles on your charts instead of bars is that single candle lines and multiple candle patterns offer more reliable, earlier, and more effective reversal signals. That is key. Reversal signals are the meat and potatoes of traders and investors. Major trend reversals represent the territory where the most gains are pocketed and lost. In addition, the ability to identify possible reversal signals on the markets is invaluable for applying money management strategies to improve profits and, equally important, preserve profits. No single technical indicator, however, represents the Holy Grail. Like all other indicators, candlesticks have limitations. Okay, so again, I highly recommend taking time reading from this book. It goes really well into depth. He even talks about a lot of the patterns we're going to look at today. And I'm going to change my share here for a second. And we're going to come over here. And I made another little Prezi for us to take a look at today. So we're going to take a look at these 4 very well-known, very common candlestick patterns. Now, we've talked about chart patterns before, and that's when you have a series of candles together forming like a physical shape on a chart. Candlestick patterns are more of a couple of candles put together to make a pattern, and the geometric shape on the chart isn't as important for candlesticks. So let's just take a look. Oops, I was a little ahead on when I was going the first time. We're looking at engulfing candles. So engulfing candles can be bearish or bullish. Investopedia has this to say: engulfing patterns are most useful following a clean downward price move, as the pattern clearly shows the shift in momentum to the upside. If the price action is choppy, even if the price is rising overall, the significance of the engulfing pattern is diminished, since it's a fairly common signal. The engulfing or second candle may also be huge. This can leave a trader with a very large stop loss if they opt to trade the pattern. The potential reward from the trader may not justify the risk. Now, this is something, and I'm going to share this presentation out, in the main group, but they're not going to get the insights that we're going to talk about as we go. And one of them that you should keep in mind as a Trade Crypto Live trainee is that we do not, most of the time, buy on the top of a green candle. You just shouldn't do it. That's a very, very basic rule of thumb. So if you get a bullish engulfing candle, those of you that have been here for a while, what would be better than buying that candle and putting a stop loss very large below? What should you do? Kenny, yes. Kenny Rogers. Wait for the pullback. Those of you that are also Slack trainees, let it center. That's what I was going to say, Guy. Excellent. We say let it center before you enter. Good, Taco. So if you get a bullish engulfing candle, personally, I'm not going to jump in on it because I'm going to wait for confirmation. And for me, the confirmation is going to be when it pulls back and lets me in and then takes off and proves it. And it says establishing the potential reward can also be difficult with engulfing patterns as candlesticks don't provide a price target. Instead, traders will need to use other methods such as indicators or trend analysis, fibs, moving averages, for selecting a price target or determining when to get out of a profitable trade. Okay, so let's just take a look. We've got bearish. So a bearish candle, a bearish engulfing candle, is going to be preceded by a white or a green candle. And then the bearish engulfing candle is going to engulf the entire body of the smaller candle. So notice the body of this black candle, and also over here on the charts, you can see the bodies of the red candles completely engulf the green candles or the white candles that precede them. That's key. Okay. Now, the pattern can be important because it shows sellers have overtaken the buyers and are pushing the price more aggressively down. Cool. So not only do we have bearish engulfing, but we have bullish engulfing. Same exact thing, except you're talking about a green candle engulfing a red candle or a white candle. So anytime you see white and black, black is always talking about red, white is always talking about green. There's a lot of variations around here. Is Mike going soft and loud for anyone else? You guys are hearing my volume vary? See if I can adjust my microphone here. Hang on, if you get some crackle, I'm sorry. Okay, how's that sound? It might be the audio trying to automatically adjust as I talk. So I'll try to be a little bit more flat toned for now. Okay, so and Colin says, and if it's in the middle of nowhere, wait for some kind of support to be built. Right. So the key to these candles, just like chart patterns, context matters. Okay. So if you get a bullish engulfing candle in the middle of nowhere, and you know, I could actually look at this one right here and say this is a bearish engulfing in the middle of nowhere. It's not at the top of a big move, an exhaustion move. It doesn't really mean a whole lot to me. But see here, you see here how they push down quite a bit, and then all of a sudden this big green candle shows up, or white in this case. You can see how it completely engulfs the candle before it, and it shows that the support is coming in to counter the down push that was just made. So right here, there's no pushes being made. So the engulfing candles are most significant when they're at the top. Boom, here's a bearish one on this chart. Or the bottom, here's a bullish one of a previous move. And how do you know it's the top or the bottom? Well, in this case, you would have known because, boom, they gapped. Right? You get confirmation afterwards. This one, when you would have known because, boom. Right? So the confirmation comes immediately after that candle, and it follows through. So those are engulfing candles. Most of you guys are probably pretty familiar with those. Is the volume still going loud and quiet, or is it doing a little better now? Good, good. Okay, good. I gave it a little adjustment, so we'll see if that holds. Now let's talk about dojis. So a doji is a name Move my chat box here. A name for a session in which the candlestick for a security has an open and close that's virtually equal. So you see when the open and close of a price is virtually equal, there isn't a body of the candle to speak of. A lot of times you'll end up with a big wick to either side. And what you're really seeing here is you're seeing indecision. So it says doji candlesticks look like a cross, an inverted cross, or a plus sign. Alone, doji are neutral patterns that are also featured in a number of important patterns. A doji candlestick forms when a security's open and close are equal. We said that. And in Japanese, doji means blunder or mistake, referring to the rarity of having the open and close price be the same. Depending on where the open and close line falls, it can be described as either a gravestone, a long-legged, or a dragonfly doji. And it's, so I'm going to read a little bit from the bottom here. It says they tend to, okay, who said that? From an auction theory perspective, this is what I want to read. Dojis represent indecision on the side of both buyers and sellers. Everyone's equally matched, so the price goes nowhere. Buyers and sellers are in a standoff. And what happens with the wicks is that's when they're battling it out through the day. But at the end of the day, or the end of the 4 hours, or the 1 hour, whatever time frame you're on, boom, we ended up right back where we started, and nothing was accomplished by either side. And then it says, doji are commonly seen in periods of consolidation and can help identify potential price breakouts. And you'll see when we go look at Bitcoin, you can almost see the dojis that are showing up right after, recently they've been making some good green candles, and then they'll pull back, and then when volume disappears, a doji will show up right before they take off again or they drop it. And it's just that indecision as the volume pitters out, and then either the sellers or the buyers come back in and push it one way or the other. So we'll take a look at that in a little bit here. Then we've got hammers. So a hammer is a price pattern that occurs when a security trades significantly lower than its opening. And you'll notice on this hammer here, so it opened up here at the top of this body, maybe went up or down. We can't see which way it went first, but during the course of the day, traded significantly lower than its open, but rallies within the period to close near the opening price. This pattern forms a hammer-shaped candlestick. So you can see the body of the hammer, and there's the handle. A hammer occurs after security has been declining. So a hammer is at the bottom of a downtrend, and it suggests the market's attempting to determine a bottom, because what happens is as the sellers are selling, the buyers are coming in stronger, and no matter how hard they try to push the price down through the day, the buyers are able to push back and get back to almost where they started. Hammers signal a potential capitulation by sellers to form a bottom, accompanied by a price rise to indicate a potential reversal in price direction. This happens all during the one period where the price falls after the open, but then regroups to close near the open. And then confirmation occurs if the candle following the hammer closes above the closing price. So here's your confirmation on your picture. Okay, and then the last one, I'm going to push through here because I want to look at Bitcoin with you guys before Scott takes it back over, is the hanging man. So a hanging man is almost the opposite in function of a hammer, but you'll notice it looks very similar, but it's not at the bottom of a move, and it's not price trading significantly lower and then coming back before a reversal. It's the opposite. So it's a hanging man candlestick occurs during an uptrend and warns prices may start falling. The candle is composed of a small real body, a long lower shadow, and little or no upper shadow. The hanging man shows that selling interest is starting to increase. Now, why does this one show selling interest is starting to increase when the other one shows buying interest? The pattern's the same. What's different? Let me see if anybody was paying attention on my subtle hints there. What's the difference? If we're seeing the exact same pattern on the chart, boom, Colin, location. That's what I was hinting at. So because we're getting buyers coming in this location where buying was happening, this type of move indicates sellers are starting to show interest. But when sellers have been coming in for a while, and we see the hammer, imagine if this was down here somewhere, a hammer comes in, it's showing that the selling is running out of strength and the buyers are coming back. So the location itself is actually what shows us whether the buyers or sellers are starting to take interest, even though the candle looks the same. They're not going to tell you that on Investopedia, but if you think about it, it kind of makes sense. Now, hanging man represents a large sell-off after the opening, yada, yada, yada. The hanging man pattern is not confirmed unless the price falls the next period or shortly after. So here's your hanging man. Here's your price fall. That's your confirmation. So candlestick traders that are trading this pattern would probably look to enter somewhere in here. They'd have a stop loss probably right above the hanging man, and they'd be waiting to buy back in somewhere because they would have went short. And after the hanging man, the price should not close above the high price. Okay, cool. So before I'm going to switch over while I'm talking, but does anybody have any questions about that? Those are all pretty straightforward patterns. Colin says yes. So go ahead, if you have questions, drop them in there. I'm going to switch over to a nice Bitcoin chart here, and I've already found an example of each of these just on Bitcoin alone. And what you'll notice is they appear on all different time frames. So if you're wondering how can I find these patterns, how can I check them out, dig into your different time frames. They show up all over the place. Right here, we've got a one-day bearish engulfing candle. I'm going to zoom into this guy so you can really see it here. Okay. Notice price action's moving up. This candle has a little bit of a small body, so we're starting to see some of the strength losing out here. Now what happens is price shoots up, the sellers come in strong, smash it down, and price isn't able to recover to where it opened by the end of the day. Notice the body of this red candle is engulfing the green one, so it's bearish, it's engulfing, and boom, down we go. Now, I would take a bearish engulfing on a one-day or preferably a one-week chart any day over anything below a one-day chart. You can get them on the 240. I wouldn't trade around them. Keep in mind, guys, these candlestick patterns are for you to make sense of the chart. They're not for you to jump into a trade. Now, they might be potential places where you could scale in, or they could signal an entry if you already had a plan and they happened around where you were looking to buy in and you had fibs to back it up and you had other analysis to back it up. They could be, but you should never, ever, ever, as a general rule of thumb, see a bearish engulfing candle and go, I need to go short and enter. Or see a bullish engulfing candle and say, I need to go. You could even kind of call this one, although it's getting kind of doji-like, I need to enter. Because these will show up everywhere, but they don't necessarily mean anything unless the location is significant. So that's a bearish engulfing. Is that candle at the bottom with the gap above it? Is that technically an invisible hammer, since the gap would be an invisible shadow? I'm looking for a gap on the chart. I'm trying to see where you're talking about. Candle at the bottom. One of these down here, maybe. Technically an invisible hammer. These hammers are silly. Yeah, they are silly. And in fact, I had to go to a 15-minute time frame to find a hammer that I really kind of was like, hey, I like that. Why don't we take a look? We'll go dig in the 15-minute. We'll look at this hammer. We're going to look at each one of these real quick, and then I'll pass it back to Scott. So if I dig in over here. No, okay, there we go. And you're going to have to really be looking to find these. But what do you see here? Price is coming down. Price ends up with a big sell-off. But we push back up and we almost make it back to where we opened. So we have a little body with a small wick or shadow to the upside and a long wick or shadow to the downside. What happens? We move up, so we get a little confirmation. Now, this is why I was saying before, you don't want to enter onto one of these right away or right on the confirmation, because look what they did. They came back and centered that wick. That would have been a better entry for me. The pattern on the pattern chart, not that one. Yeah, okay. Yeah, so the pattern charts they were using on Investopedia that I pulled were from stocks and other asset markets where you get more gaps. We don't get gaps as much in crypto because we're 24/7. Gaps show up more. They do show up, but they show up more frequently in other markets because markets close and sentiment changes before they open. So you see them more often in traditional markets. So those pictures, yeah, I see what you're talking about, Colin. And you could kind of call it that if that's what you wanted to call it. I would never try to trade around it. But so we got a 15-minute hammer here. And then what do you see? Comes up. Boom, there we go. Let's go back to the one. We have 2 more to look at real quick, and then I'm sure Scott will be almost back or close to it. Where's my chart here? Okay, we're way back up here. I already got the hammer. So I talked about my bearish engulfing. We've also got a hanging man. Now, remember I said candlesticks and candlestick patterns are for making sense of what you're looking at. Now, some of us are seeing kind of a downtrend being formed here on Bitcoin. I'm not going to make it super pretty. But what I would expect to see from candlestick patterns confirming this kind of a downtrend with these 1, 2, 3 touches. Well, look at this. We got 1 touch, what looks like a bearish engulfing. Even though the wick doesn't matter, we're looking at the bodies. So this is a bearish engulfing. 2 touch, bearish engulfing. 3 touch, hanging man, followed by a bearish engulfing. So that to me says we're not going past it, we're not going past it, we're not going past it. Here's my downtrend. Could they break it? Yes. But these candlestick patterns are showing me that the high probability of what they're trying to do is get back down. That's the more probable, and the sentiment in multiple locations now is backing that idea up. So confirmation. And then the last one, which we can look at real quick because I hear Scott coming back.
You're good. You're doing good.
We can take a look at this 4-hour Dragonfly Doji. If I could get my...
I taught him everything he knows. I did. Not everything he knows.
Taught me most of what I know.
He knew some stuff before he got to me.
Okay, and here's our 4-hour Dragonfly Doji. So notice here, indecision. Price almost opens where it closes. Long wick to the downside, so we call it a Dragonfly. And it happens...
Sparky Boom Boom.
After this, yep, Sparky Boom Boom, right? And that's those names we're talking about. We call that a Sparky Boom Boom. And it shows us, oh, wait, so we're not sure what we're doing here. Are we going to continue this? No, we're not. Here comes the buyers, and we've got some buying volume. We're turning it. So we liquidate them, and we're going. So keep in mind, guys, these candlestick patterns, they're all over. Dig into all your time frames. Look for them. Find 100, 200, 300 of them. And then see if they do what they're supposed to do. See if they show you confirmation. If this ends up being our downtrend and we turn it here and we come down, these are beautiful examples of bearish engulfing, hanging man, bearish engulfing. Boom, we're going down. 1, 2, 3, downtrend.
Going down to make a lower low.
Lower lows. So hopefully that gave you guys a little more insight into those 4 candlestick patterns. Again, we looked at engulfing candles, dojis, hammers, and hanging men. We read about what they look like, their definitions.